Today is Thursday, March 5th, 2026, and it was a volatile session on Wall Street as investors reacted to rising geopolitical tensions, surging oil prices, and renewed uncertainty about the path of interest rates. The major U.S. indexes all closed lower. The Dow Jones Industrial Average fell about 785 points, or roughly 1.6%. The S&P 500 dropped around 0.6%, and the Nasdaq Composite slipped about 0.3% by the end of the trading day. The decline came as investors reassessed risk across global markets amid escalating tensions in the Middle East. The biggest catalyst behind today's sell-off was energy. Oil prices surged above $80 per barrel, their highest level since the summer of 2024, after the conflict involving Iran continued to intensify. Markets are increasingly worried about potential disruptions in the Strait of Hormuz, one of the most important oil shipping routes in the world. Roughly a fifth of global oil supply moves through that narrow waterway, so any threat to it immediately shakes financial markets. Higher oil prices create a ripple effect throughout the economy. When energy costs rise sharply, inflation tends to follow. That raises concerns that the Federal Reserve may have to keep interest rates higher for longer, delaying the rate cuts many investors were hoping for later this year. Bond markets reflected that shift in expectations today. Treasury yields moved higher, with the 10-year yield climbing to around 4.14%. Rising yields often pressure stock valuations because higher borrowing costs make it more expensive for companies to invest and expand, while also making bonds more attractive relative to equities. As a result, economically sensitive sectors struggled the most. Airline stocks dropped sharply because higher oil prices directly increased their fuel costs. Smaller companies also took a hit, with the Russell 2000 index falling more than the broader market, reflecting growing concerns about the economic outlook. Technology stocks were somewhat more resilient, though still under pressure as investors continue to weigh the impact of higher rates on growth companies. Semiconductor stocks in particular saw mixed trading, even as artificial intelligence remains one of the strongest long-term themes in the market. While equities were falling, investors also looked closely at alternative assets today, including precious metals and cryptocurrency. Gold continues to trade near historically elevated levels, hovering around $5,100 per ounce. Silver is also holding strong near the mid-$80 range per ounce. Both metals have seen massive gains over the past year as investors search for protection against inflation, currency volatility, and geopolitical instability. Periods of global uncertainty often drive investors towards safe haven assets like gold and silver. Even though prices have been volatile in recent weeks, both metals remain dramatically higher than they were just a year ago, reflecting strong global demand for hard assets. Meanwhile, Bitcoin continues to stabilize after a turbulent start to the year. The world's largest cryptocurrency is trading around $72,000 today. Bitcoin has experienced sharp swings over the past several months, but some analysts believe the recent stabilization could mark the early stages of a recovery following the steep corrections earlier in the year. The growing attention on Bitcoin alongside gold and silver highlights an interesting shift in investor behavior. Increasingly, markets are treating these assets as alternative stores of value during times of economic uncertainty. While they behave differently, all three have become part of the broader conversation about protecting wealth during volatile periods. Looking beyond today's trading session, the bigger story remains the intersection of geopolitics and monetary policy. The ongoing conflict in the Middle East has already pushed energy prices higher and introduced significant uncertainty into global markets. If the situation escalates further, oil prices could climb even higher, potentially reigniting inflation pressures worldwide. That creates a difficult situation for central banks. On one hand, higher inflation would argue for keeping interest rates elevated. On the other hand, higher energy costs could slow economic growth, increasing the risk of what economists call stagflation, a combination of rising prices and slowing growth. Investors are also watching upcoming corporate earnings and economic data for additional clues about the health of the U.S. economy. Retail earnings in particular will provide insight into consumer spending, which remains the backbone of economic growth. The labor market will also remain a key focus. Strong employment data has been one of the primary reasons the U.S. economy has remained resilient despite higher interest rates over the past 2 years. So, to summarize today's market action, stocks moved lower as oil surged and geopolitical tensions intensified. Bond yields climbed as investors reassessed the outlook for interest rates, and alternative assets like gold, silver, and Bitcoin remained in focus as investors searched for stability in an increasingly uncertain environment. As we move further into March, markets will likely remain sensitive to headlines coming out of the Middle East, movements in oil prices, and any signals from the Federal Reserve about the future path of interest rates. For now, volatility remains the dominant theme across global financial markets. If you want to stay up to date on the market news, please don't forget to like and subscribe.